Here's a genuine contradiction worth understanding, not just repeating as a headline. Japan's currency just hit its weakest level against the dollar in roughly 40 years. Its government bond yields are sitting near 3-decade highs, and its government debt load is one of the largest of any developed economy on Earth. And yet, over the trailing 12 months, Japan's Nikkei 225 stock index has gained somewhere in the range of 68%, according to the most recent data, dramatically outpacing the S&P 500's roughly 9% to 11% gain for 2026 so far. That's not a typo, and it's not a coincidence either. It's a real, well-understood mechanism in how currencies, bonds, and stocks respond to completely different forces, and understanding it will change how you read financial headlines going forward. If that sounds useful, subscribe now, because I'm going to walk through exactly how both of these things are true at the same time. Drop a comment too. Do you hold any Japanese stocks, directly or through an international fund? I want to know how many of you already have exposure to this story without realizing it. Let's ground this in the actual numbers before we get into the mechanism, because they're genuinely striking on their own. This week, the Nikkei has been trading in the range of $67,000 to roughly $68,700. After pulling back a few percentage points on renewed selling in Japan's big semiconductor names amid broader concerns about the sustainability of the AI trade, plus fresh escalation in the Middle East pushing oil prices higher again. Even with that pullback, the index remains roughly 68% higher than it was a year ago. An extraordinary 12-month result by any historical standard for a major developed market index. Compare that to the S&P 500, which has delivered a solid but far more ordinary 9% to 11% gain year-to-date in 2026. That's a real, multiple times performance gap between two of the world's largest stock markets, running in parallel with Japan's currency and bond troubles rather than instead of them. So how does a country with all of that going on in its bond market and currency produce a stock market boom at the same time? The answer starts with understanding that stock prices and bond prices respond to genuinely different forces, even though we often lump them together casually as the market. Bond investors care primarily about a government's ability to repay debt reliably and about inflation eroding the real value. A weak currency and rising bond yields can genuinely hurt government bonds while simultaneously helping corporate profits. And that split is exactly what's playing out inside Japan right now. Here's mechanism number one, and it's the most direct, the weak yen itself. Japan's largest, most influential companies, names like Toyota, Sony, and major industrial exporters, sell enormous volumes of product overseas, particularly into American markets. When the yen weakens against the dollar, every dollar of foreign revenue converts into more yen than it used to. A car sold for $30,000 in the US now converts into meaningfully more yen than it would have a few years ago, and that shows up directly in these companies' reported profits, in yen terms, without those companies needing to sell a single additional unit. Japan's stock index happens to be heavily weighted toward exactly this kind of exporter, which is a big part of why a weak currency, genuinely painful for Japanese households buying imported food and energy, has been simultaneously good news for corporate earnings and stock prices. Mechanism number two connects to something Japan hasn't experienced in decades: real, sustained inflation. For roughly 30 years, Japan struggled with the opposite problem: deflation, where prices fell over time. That sounds harmless on the surface, but it's genuinely corrosive for an economy because both companies and consumers rationally delay spending when they expect things to get cheaper later, which drags down growth and investment year after year. That multi-decade deflationary mindset is what's finally shifting. Inflation has returned to Japan in a real, sustained way this year, and while that same inflation is squeezing Japanese households on the cost of living side, which we've covered separately, it's also allowing Japanese companies to raise prices, pay higher wages, and post stronger nominal profit growth than they've seen in a generation. Investors have been pricing in that structural shift away from deflation as a genuine multi-year change, not a temporary blip. And that reassessment alone has pulled real capital into Japanese equities this year. That's two of the four real mechanisms behind this rally: the weak yen boosting exporter profits and the return of inflation, supporting nominal earnings growth after decades of stagnation. In the next section, I want to walk through the other two forces driving this, a genuine multi-year corporate governance reform story coming out of the Tokyo Stock Exchange, and the direct connection between Japanese capital leaving US Treasuries and flowing into Japan's own stock market instead. Stick around, because this is where the story connects back to global capital flows in a way most coverage misses entirely. Let's get into mechanism number three, and this one is a genuine multi-year structural story, separate entirely from currency swings or inflation dynamics. Corporate governance reform coming out of the Tokyo Stock Exchange. For years, Japanese companies had a well-known reputation for sitting on enormous cash piles and doing very little productive with them. low returns on equity, minimal share buybacks, and thin dividends relative to global peers. The Tokyo Stock Exchange has spent several years now actively pressuring listed companies to fix this, pushing firms trading below book value to explain their capital plans publicly and encouraging meaningfully higher buybacks and payouts. This wasn't a single announcement. It's been a sustained multi-year campaign, and it's shown up in real numbers. Buybacks reduce the number of shares outstanding, which mechanically boosts earnings per share, and higher dividends have pulled in income-focused global investors who'd ignore Japanese equities for decades. That's a genuinely different kind of driver than currency effects. It's a structural improvement in how these companies are run, not just a favorable exchange rate. And here's where Mechanism 4 comes in, tying directly back to the US Treasury story. We've covered separately capital flows. We've already discussed how Japanese institutional investors, pension funds, life insurers, banks, have been reassessing their massive historical holdings of US Treasuries now that Japan's own bond yields offer more competitive returns without currency risk. Some of that capital doesn't just move into Japanese government bonds. A portion has been flowing into Japanese equities directly, as domestic investors see genuinely improving opportunities at home for the first time in decades. On the foreign side, there's a specific, well-documented example worth knowing. Warren Buffett's Berkshire Hathaway has built stakes now exceeding 10% in Japan's 5 largest trading houses, Itochu, Marubeni, Mitsubishi, Mitsui, and Sumitomo, after first taking roughly 5% positions back in 2020 for about $6.25 billion combined. That position has grown enormously in value since. Reporting this year has put the total near $30 billion or more, with Berkshire's own disclosures confirming it's been adding to these stakes as recently as this spring. Buffett has said publicly he expects to hold these positions for the long term, even describing Japan as one of the largest bets in Berkshire's entire public equity portfolio outside the US. When one of the most closely watched investors alive keeps adding, and it's genuinely part of why global capital has taken Japan more seriously as an investment destination again. Now here's the part worth addressing directly, because it's the actual heart of this video's premise. How do bond market stress and stock market strength coexist without contradicting each other? The honest answer is that this isn't actually unusual once you understand the mechanism. It's a fairly well-documented pattern that shows up whenever a currency devaluation and rising inflation hit an export-heavy economy at the same time. Bond investors are pricing in a government's ability to repay long-term debt and the risk that inflation erodes fixed payments, exactly the pressure driving Japan's 10-year and 40-year bond yields to multi-decade highs this year, alongside real concern about Prime Minister Sanae Takaichi's fiscal stimulus plans and proposed tax cuts adding to an already historic debt load. Stock investors, meanwhile, are pricing in corporate earnings, and for Japan's exporter-heavy, buyback-friendly, newly inflation-supported companies, those earnings have genuinely improved. Both forces are real. Neither one cancels the other out. They're simply responding to different parts of the same underlying economic shift. It's worth being honest, too, that this rally hasn't been a smooth, uninterrupted climb. That's an important nuance often lost in headline comparisons. Japan's bond market experienced a sharp, genuinely alarming shock. Earlier this year, in January, when 40-year JGB yields crossed 4% for the first time since that maturity was introduced, and 30-year yields saw their largest single-day jump in decades, triggered by the snap election announcement and Takaichi's stimulus pledges. During that same volatile stretch, the Nikkei itself dipped several percent over short periods, even while the underlying trading house and exporter names kept climbing on the back of the same conditions, causing the bond stress. More recently, in mid-July, the index pulled back again amid renewed selling in Japan's big semiconductor names, Kioxia, Tokyo Electron, Advantest, as global investors grew more cautious about how sustainable the broader AI trade actually is, compounded by fresh escalation in the Middle East, pushing oil prices higher. None of that erases the underlying 12-month trend, but it's a useful reminder that this rally has had real volatility built into it, not a straight line upward. So here's the honest synthesis so far. 4 real distinct mechanisms: a weak yen boosting exporter profits, returning inflation supporting nominal earnings after decades of stagnation, a genuine multi-year corporate governance reform push, and real capital reallocation both domestically and from high-profile foreign investors are working together to produce Japan's stock market strength, even as the same underlying currency weakness and fiscal pressure are producing genuine stress in Japan's bond market. Both stories are true. Neither one is fake or exaggerated. What I want to get into next is the risk side of this equation, honestly, because this rally isn't guaranteed to continue, and there are specific, identifiable things that could genuinely end it. Stick around for that. Let's talk honestly about what could actually end this rally, because no market story is complete without a clear look at the real risks, and there are several concrete ones worth understanding rather than glossing over. The first risk loops directly back to the bond market stress itself. If Japanese government bond yields keep climbing from here, and they're already sitting near 3-decade highs on the 10-year, with the 40-year having briefly crossed 4% earlier this year for the first time since that maturity was introduced back in 2007, borrowing costs rise for everyone in the Japanese economy, not just the government. Corporations need credit to expand operations, build new capacity, and fund investment. And if that credit becomes meaningfully more expensive, even companies posting strong export profits start facing higher costs on the other side of their balance sheets. So far this year, the export profit boost from the weak yen has clearly outweighed the drag from rising borrowing costs. That's part of why the rally has held up despite the bond market turmoil. Whether that balance continues to hold as yields keep climbing is a genuinely open question, and it's one of the more important things to watch going forward rather than assume will resolve favorably. The second risk is currency intervention itself, and it cuts directly against the mechanism driving this rally. Japan's Ministry of Finance has already intervened directly in currency markets this year, spending tens of billions of dollars trying to slow the yen's slide, though with limited lasting effect so far. The currency has continued drifting back toward its weakest levels even after intervention. But if Japan ever succeeds in meaningfully strengthening the yen, whether through more aggressive intervention, faster Bank of Japan rate hikes, or some combination of both, that export profit boost we described in the last section disappears quickly. A stronger yen makes Japanese products more expensive and less competitive overseas, which directly hits the profits of exactly the exporter-heavy companies that have been driving this rally. Given that the Bank of Japan has left the door open to further rate hikes at its policy meetings this year, this isn't a hypothetical risk sitting on the shelf. It's an active, monitored possibility tied to specific, dated policy meetings. The third risk involves Japan's political situation directly. Every major party currently campaigning is pushing some version of increased government spending. More fiscal stimulus, tax cuts, defense spending increases, all of that requires issuing more government bonds to finance it, which loops straight back into the first risk. More bond supply generally means higher yields, all else equal, especially with Japan's debt-to-GDP ratio already sitting above 200%, among the highest of any major developed economy. Political uncertainty during election periods tends to spook markets in the short term too, simply because elections introduce genuine unpredictability into fiscal forecasts that investors have to price in before they know the actual outcome. The fourth risk sits entirely outside Japan's control: the health of its major trading partners, especially the United States. Japan's economy leans heavily on exports, and if American demand slows meaningfully, whether from a broader economic slowdown or renewed trade friction, that directly threatens the export profit engine behind this rally. It's also worth noting that Japan's auto industry has already been dealing with real tariff pressure this year, with Toyota and other major manufacturers. U.S. large cap indices have become historically concentrated in a small handful of companies. Depending on which measure you use, the top 10 stocks in the S&P 500 now account for somewhere between roughly 37% and 41% of the index's total weight, and the top 5 alone represent around a quarter of it, driven heavily by the ongoing AI-related rally in a small group of mega-cap tech names. That's a well-documented, historically elevated level of concentration, confirmed by multiple independent data providers. Some investors view that concentration as a reason to look for exposure with genuinely different underlying drivers and lower correlation to that specific handful of American tech names. And Japan, with its very different sector composition, weighted more toward exporters, trading houses, financials, and industrials, is one place that diversification conversation naturally leads. That's a reasonable, evidence-based argument for considering broader geographic diversification generally. It is not, on its own, a signal to chase last year's best-performing index or make a dramatic allocation shift based on a single country's 12-month return. And that's really the caution worth ending on. Performance chasing based on a headline number is one of the most well-documented mistakes in investing, and Japan's own history is actually the clearest possible illustration of exactly that risk. The late 1980s Japanese stock boom that we discussed last section eventually became one of the most painful, multi-decade cautionary tales in modern financial history. The Nikkei only reclaimed its 1989 peak level in the past couple of years, meaning investors who piled in near that top waited literally decades to get back to even. Today's rally rests on a meaningfully different foundation: real corporate governance reform, genuine returning inflation, measurable currency dynamics, rather than the speculative real estate and reckless lending that drove the earlier bubble. But different foundation doesn't mean guaranteed to continue, and nobody, including me, can responsibly promise you which of the specific risks we covered in the last section, rising bond yields eventually crushing corporate borrowing costs, a sudden currency reversal, political instability around fiscal policy, or a slowdown in demand from Japan's trading partners, ends up mattering most from here. So here's the honest, balanced conclusion. Japan's stock market strength and its bond market and currency stress are both real, both well documented, and both driven by genuinely different mechanisms responding to the same underlying economic shift. A weak yen and returning inflation that happen to help exporter profits while simultaneously hurting government bond investors, and ordinary Japanese households facing higher import costs. That's not a contradiction once you understand the mechanism. It's actually a fairly well-established pattern in how currency devaluations interact with export-heavy economies, and it's playing out in Japan in close to real time this year, with genuine volatility along the way rather than a clean, uninterrupted climb. If this gave you a clearer, more grounded understanding of why these two headlines can both be true at once, subscribe so you catch the next update as this story develops, particularly around Japan's upcoming politicals and Bank of Japan decisions, which are the specific dated checkpoints most likely to move this story meaningfully in either direction. And drop a comment. Does this change how you think about diversifying beyond US markets, or are you staying put? I read every one of them.